When headlines started claiming that China had banned gold trading, the news spread across financial media almost instantly. Some people believed China was preparing for an economic crisis. Others thought it was trying to manipulate the price of gold or even challenge the dominance of the US dollar. But the reality is more interesting than the headlines suggest. China hasn't banned people from owning gold, and it hasn't outlawed gold altogether. Instead, it has quietly restricted a specific part of the gold market, one that most ordinary investors never fully understood in the first place. While this may sound like a minor regulatory change, it actually reveals something much bigger about how China views financial stability, speculation, and the future of global markets. To understand why this matters, we first need to understand the difference between owning real gold and simply betting on its price. Physical gold is exactly what it sounds like: gold bars, coins, or jewelry that you can actually hold in your hands. Paper gold, on the other hand, is completely different. It includes financial products like derivatives and leveraged contracts that allow investors to profit from changes in the price of gold without ever owning the metal itself. These products have become incredibly popular because they allow traders to make large profits with relatively small investments. But that same leverage also creates enormous risks. A small movement in the gold price can quickly turn into significant gains or devastating losses. This is exactly the area China has decided to target. Several major Chinese banks have either suspended or significantly reduced retail access to leveraged gold trading products. In many cases, they've also increased margin requirements, making it much more expensive for everyday investors to speculate on gold prices. This isn't a move against gold itself. Instead, it's a move against excessive speculation. China's regulators appear to believe that too much leverage creates unnecessary financial risk, especially during periods of high market volatility. By making leverage trading more difficult, they hope to reduce sudden price swings and prevent inexperienced investors from taking on risks they may not fully understand. The timing of this decision is especially important. Over the past year, gold has experienced dramatic price movements as investors around the world searched for safe assets during periods of economic uncertainty. Inflation concerns, geopolitical tensions, central bank buying, and uncertainty surrounding interest rates all helped push gold prices higher. But rapid rallies often attract speculative traders looking for quick profits. As more investors pile into leverage positions, the market becomes increasingly unstable. Once prices begin moving in the opposite direction, those same leverage positions can trigger forced selling, creating a chain reaction that causes prices to fall much faster than normal. Regulators have seen this pattern before, and China appears determined to reduce the chances of it happening again. From Beijing's perspective, financial stability is rarely left to market forces alone. Unlike many Western economies that often allow markets to correct themselves, China has a long history of stepping in whenever it believes excessive speculation could threaten broader economic stability. Whether it's the stock market, the property sector, cryptocurrencies, or now leveraged gold trading, Chinese policymakers have consistently shown a willingness to intervene before financial risks become systemic problems. Their philosophy is simple: preventing instability is easier than cleaning up the damage afterward. But this decision could also reflect a broader strategic vision. Around the world, central banks have been steadily increasing their gold reserves over the past several years. Gold has become increasingly attractive as countries seek to diversify away from assets denominated in US dollars. At the same time, geopolitical tensions and concerns about sanctions have encouraged many governments to rethink how they manage their foreign reserves. China has been one of the most active buyers of physical gold, signaling that it sees the precious metal as an important long-term strategic asset. Against that backdrop, reducing speculative paper trading while continuing to support physical ownership begins to make much more sense. One of the biggest differences between physical gold and paper gold is their impact on price discovery. Modern gold markets are heavily influenced by futures contracts, derivatives, and other financial products that represent claims on gold rather than actual ownership of the metal. In many cases, the total value of paper gold trading exceeds the amount of physical gold that actually exists. This means prices can sometimes be driven more by short term speculation than by genuine supply and demand. By reducing access to highly leveraged trading products, China may be trying to shift more attention toward the physical market, where prices reflect actual buying and selling rather than purely financial bets. This doesn't necessarily mean global gold prices will suddenly change overnight. International gold markets remain highly interconnected, with major trading centers in London, New York, Shanghai, and Hong Kong all playing important roles. However, China's policies can still have significant influence because of the country's size. As one of the world's largest consumers and importers of gold, any major change in Chinese demand or trading behavior naturally attracts global attention. Investors understand that when China adjusts its financial policies, it often has long-term objectives rather than short-term reactions. There's another reason why this story deserves attention. In recent years, China has been working to strengthen its own financial infrastructure and reduce dependence on Western-dominated financial systems. From expanding the international use of its currency to developing alternative payment systems and strengthening commodity exchanges, China has consistently pursued greater financial independence. Gold fits naturally into that broader strategy. Physical gold is universally recognized, carries no counterparty risk, and isn't controlled by any single government. Encouraging ownership of real assets while discouraging excessive financial speculation aligns closely with China's long-term economic philosophy. Of course, not everyone agrees with this approach. Critics argue that restricting retail trading reduces market freedom and limits opportunities for individual investors. They believe markets function best when participants are free to make their own decisions, even if those decisions involve significant risk. Supporters of China's policy, however, argue that highly leveraged financial products often create artificial volatility that benefits professional traders far more than ordinary investors. From this perspective, limiting excessive speculation isn't about restricting opportunity. It's about protecting financial stability and reducing systemic risk. For investors outside China, the immediate impact may be limited. Most global investors will continue trading gold through futures markets, exchange-traded funds, mining stocks, or physical bullion, just as before. But the broader message behind China's decision is worth paying attention to. Governments around the world are becoming increasingly aware of the risks created by highly leveraged financial markets. As economic uncertainty grows and geopolitical tensions remain elevated, regulators may become more willing to intervene whenever speculation threatens market stability. Perhaps the biggest lesson from this story is that headlines rarely tell the complete picture. Saying that China banned gold trading creates an eye-catching narrative, but it doesn't accurately explain what's happening. China isn't trying to eliminate gold from its economy. In fact, if anything, the country appears to be reinforcing the importance of physical gold while reducing the influence of speculative financial products built around it. That's a very different story, and one with potentially much larger implications for the future of global finance. Ultimately, this isn't simply about gold. It's about how one of the world's largest economies wants its financial system to function. China is signaling that it prefers long-term stability over short-term speculation, real assets over excessive leverage, and strategic accumulation over rapid trading. Whether other countries choose to follow a similar path remains uncertain, but one thing is becoming increasingly clear. As global financial systems continue to evolve, the balance between physical assets and financial speculation will become one of the defining economic debates of the coming decade. China's latest move may look like a small regulatory adjustment today, but it could ultimately be remembered as another step in a much larger transformation that is quietly reshaping the architecture of global finance.